This did not start as just another war headline. It turned into a market shock the second traders realized the real risk was not only missiles, but movement. Around 20 million barrels a day moved through the Strait of Hormuz in 2024, equal to about 1/5 of global petroleum liquids consumption. That is why this conflict matters far beyond the region. When the world's biggest oil choke point is under pressure, the whole pricing system starts to shake. And this is where the story gets serious. The International Energy Agency said oil and product flows through the Strait of Hormuz plunged from around 20 million barrels a day before the war to just over 2 million in March. Brent posted its largest ever monthly gain, and the IEA described it as the most severe oil supply shock in history. That is not routine volatility. That is a system-level warning. IEA. Why this hits harder than people think. A lot of people hear oil shock and think gas stations. That is too narrow. Oil is the input behind shipping, trucking, aviation, plastics, chemicals, and a huge part of industrial production. The strait also carries around a quarter of global seaborne oil trade and significant lang flows, which means this is not only an energy story, it is also a transport story, a manufacturing story, and very quickly, an inflation story. UNCTAD IEA. It gets worse when you follow the second-order effects. UNCTAD warned that higher energy, transport, fertilizer, bunker fuel, and insurance costs can push food prices higher and hit vulnerable economies especially hard. So the real threat is not just expensive oil. It is the chain reaction, fuel gets pricier, shipping gets slower, fertilizer gets costlier, food gets squeezed, and fragile economies get less room to breathe. UNCTAD. The historical echo. The reason markets take oil shocks so seriously is simple. They have a record. The World Bank ties the 1973-74 oil shock to the 1975 global recession and says the 1979 oil shock helped set up the 1982 global recession by driving inflation higher and forcing aggressive monetary tightening. Oil shocks do not just raise prices, they corner central banks and drain growth at the same time. World Bank. That is why this comparison matters. Brookings wrote that the current global oil market shortfall is larger than the 1973 and 1979 oil crises combined. Reuters described the current disruption as the worst hit to energy supplies in modern times, with factories already facing higher production costs and business surveys showing strain spreading from manufacturing into services. That is the part investors cannot ignore. Once an energy shock leaks into services, confidence, and hiring, it stops being a commodity story and becomes an economy story. Brookings Reuters. What changes everything? Now the obvious question. Does this automatically mean a global recession? Not automatically. The world has some buffers it did not have in the 1970s. Economies are less oil-intensive than they were back then, and there are emergency stockpiles, plus some pipeline alternatives from Saudi Arabia and the UAE. But the key word is some. IEA says only limited bypass capacity exists, and the IEA says reopening normal Hormuz flows remains the single most important variable for easing pressure on energy supplies, prices, and growth. World Bank IEA. The IMP's rule of thumb makes the risk easy to understand. A persistent 10% increase in oil prices can add about 0.4 percentage points to global inflation and shave about 0.1 percentage points off global growth. That may sound small until you remember that economies are already dealing with debt pressure, weak confidence, and fragile supply chains. Stack a major oil shock on top of that, and small numbers stop staying small. IMF. The smarter read. So what should people actually watch now? Not just the oil chart. Watch whether shipping through Hormuz normalizes. Watch diesel and jet fuel, because those markets get tight fast. Watch fertilizer and freight costs, because that is where the consumer hit starts spreading. Watch purchasing manager surveys, because Reuters is already seeing the damage show up in factory costs, service activity, and corporate guidance. By the time the pain reaches headlines about slower growth, the market has usually priced a lot of it in already. Reuters UNTAD. The biggest mistake is treating this like a regional conflict with a temporary price spike. If the disruption lasts, this becomes a global margin squeeze. Companies pay more to move goods, consumers pay more to live, central banks get less flexibility, and growth forecasts start sliding. That is how an oil shock turns into an economic shock. Not all at once, but layer by layer. World Bank. What to do next? The real story is not only who fired first, it is who pays last. And if this route stays unstable, the answer is simple: households, companies, and entire economies. That is why this matters, not as a headline, as a pricing engine for everything that comes after it. If you want finance coverage that tracks the money behind the headlines, not just the headlines themselves, subscribe and stay close, because the next phase of this story will not show up first on a battlefield. It will show up in inflation prints, earnings calls, and growth cuts.